price is lying and the spread is telling the truth. And that mismatch is exactly what shows up right before the market forces a decision that most people want to be emotionally ready for. Because right now, gold and silver look like they're calming down after a wild run. And the loudest voices are already trying to frame this as the top, the blow-off, the moment the story ends. But that's not the part that matters. The part that matters is what the market is charging for time, for delivery, for certainty, and for immediate metal versus metal later. Because that's where the pressure builds quietly until it doesn't feel quiet anymore. Stay with me, because by the end of this, you'd all have the cleanest two-scenario roadmap for the next 1 to 2 weeks. What level matters? What would confirm this? What would break it? And what to watch that almost nobody on finance TV ever brings up? Right now, the surface level picture is simple. Gold is sitting in the low 4,000s area. Silver is in the low 70s area. And both have been through the kind of fast, violent swings that make people swear off metals entirely. One day it feels like free money. The next day it feels like a trap. And that emotional whiplash is not an accident of nature. It's a feature of a market where leverage, hedging, and liquidity all take turns steering the car. But here's the crucial part. After a blowout move, a sharp shakeout, and a bunch of "I told you so" commentary, a lot of traders look at the chart and assume the story is over. Yet the markets that actually end don't behave like this. They don't rip, dump, and then refuse to break. They don't attract forced selling and then hold key zones like they're just a bid underneath that does not care about your feelings. And that's where the real pressure starts. Let's talk about what's actually happening in plain language without the usual fog. When people say gold is up or silver is down, they're talking about the spot price, the headline quote. But the market is bigger than the headline. There's the futures curve, which is basically the market's opinion about price over time. There are spreads between near months and far months. There's the cost of carry, storage, financing, insurance, and the willingness to warehouse metal. There are options sitting on top of futures, changing dealer hedging behavior depending on where price lands. And there's the physical reality underneath it all. Actual bars in actual vaults that can actually be delivered. If you watch only the headline, you're watching the shadow on the wall. If you watch the curve, the spreads, and the behavior around delivery windows, you start to see the hand moving the puppet. And that's the hidden detail most people miss. Here's the conflict, and it oughts the whole video in one sentence. The public narrative wants you to believe this is just sentiment cooling off, but the market structure is whispering that the system is still tight in the places that matter. That doesn't mean price can't dump. It absolutely can. It means the why behind a dump is often not everyone suddenly hates gold. It's margin systems forcing liquidation, dealers adjusting hedges, funds rebalancing, and weak hands getting rinsed so stronger hands can accumulate without chasing. And when that's what's happening, the next move is not random, it's conditional. It depends on very specific pressure points. And the next detail is what flips the whole setup. So let's go straight into the underappreciated mechanism that reframes everything. The price of immediacy. In most normal conditions, gold futures trade in a gentle contango, meaning futures for later delivery are priced a bit higher than spot. That makes intuitive sense. You're paying for time, for storage, for financing. Silver can do similar things, though it can get more dramatic because it's a thinner market and it is tied to industrial flows. But when the front of the curve stops behaving normally, when near-term contracts get unusually strong versus later contracts, or when spreads tighten in a way that suggests people are paying up for the front end, that S not emotion, that's math. It's the cost of certainty rising. It's the market saying, I want it now, not later, or I can't afford to be short the near term. And when that happens, it forces real behavior. Here's what it forces. If you were a participant who is short the front, maybe you sold futures as a hedge, maybe you're a market maker managing inventory, maybe you were a fund that S short as a trade, then an unusually strong front end makes it expensive to stay short without paying a penalty through the spread. If you roll your short, you might have to buy back the near contract and sell a later one, and the spread can hurt you. If you're a fabricator or an industrial user, that front-end strength can signal that waiting carries a risk. If there's any hiccup, you get squeezed on availability. If you're a bullion bank, you're thinking about funding costs, lease rates, and the risk of a delivery squeeze when liquidity is thin. The headline price can be flat while the front-end tension builds. And then one day, the headline price suddenly mysteriously jumps. It wasn't mysterious, it was pressure migrating. Because if this one level breaks, the math changes. Now let's ground this in reality without pretending we have perfect clairvoyance. The last stretch of action in metals has been defined by three things: explosive upside moves, sharp pullbacks, and stubborn bids that keep showing up in the same zones. That's not a slow, sleepy market. That's a market with positioning, with leverage, with competing time horizons. And it's a market where the difference between trend and noise is not a philosophical debate. It's the difference between holding a thesis and panic selling the bottom. But that's not the part that matters. What matters is why now. The why now is the calendar. Early January is notorious for thin liquidity and fresh positioning. Books are reset, funds rebalance. Some players put on new trades with new risk limits. Other players take profits because they can finally mark a win and start the year clean. Dealers look at their option exposures and decide what they can tolerate. And the market is also staring at the next policy and data windows, central bank messaging, inflation prints, employment data, because metals don't move in a vacuum. Even if you don't care about macro, macro cares about you. And when liquidity is thin, small flows move price like big flows. That's why you get gaps, air pockets, and what just happened? Candles. And that's exactly when the market uses volatility as a weapon. Let's talk about that weapon, because it's the thing that destroys retail investors more than any chart pattern ever will. Margin and forced selling. When metals run hot, exchanges can raise margin requirements. Brokers tighten risk, volatility spikes, and suddenly the same position size that felt fine last week becomes unmanageable this week. If you're leveraged, futures, options, CFDs, even some forms of leveraged ETFs, a 2% move can behave like a 20% hit depending on your leverage. That's not drama, that's arithmetic. So when price swings, it triggers margin calls, which force people to sell, which pushes price further, which triggers more margin calls. That's a liquidation loop. And the loop doesn't care if your thesis is correct. It only cares whether you can hold through the path. Because the market can whip around violently even if the thesis is right. That's why people lose money being right. And that's why the best operators separate the signal from the noise. Now, here's where most commentary gets lazy. They'll say, gold fell because yields rose, or silver fell because risk on turned risk off. Sometimes that's true on the surface. But the deeper truth is that metals are also driven by the structure of the paper market. Futures and options create reflexive behavior. And I want you to understand one simple concept that changes how you watch price: dealer hedging. When a lot of options are open at certain strike prices, dealers, who are often on the other side of your option trade, hedge their exposure by buying or selling futures as price moves. In some zones, their hedging dampens volatility. In other zones, it amplifies it. If price is near a big strike into an expiration window, it can get pinned. If price breaks away, hedging can chase the move and accelerate it. That's not conspiracy. That's risk management. It's how a dealer stays neutral. But it means price can move for mechanical reasons that have nothing to do with fundamentals on that day. And that's where people get tricked. So what are the fundamentals that actually matter in the near term? Let's stack proof, not vibes. First proof point, the curve and the spreads. If the front end of the curve is unusually firm, or if spreads are acting like the market is paying for immediacy, that's a signal that physical or near-term hedging demand is not satisfied. You don't need to know every number. You need to know the direction of pressure. When the cost of waiting rises, the market is telling you something about availability and risk. Second proof point, inventory categories. People love to point to vault totals, as if every bar is for sale at the last traded price. That's not how it works. There's metal in vaults that is allocated to someone and not available. There is metal that is eligible, but not registered for delivery in certain systems. There's metal sitting in places that are logistically slow to mobilize. The headline number can look comforting while the deliverable float is tight. And in tight moments, it's the float that matters, not the total. Third proof point, institutional flow behavior. ETFs and institutional vehicles can be fickle in the short term, but when you see persistent demand returning after shakeouts, it matters because those buyers are not buying a meme. They're buying a hedge. They're buying a balance sheet decision. They were buying because something in their macro framework says the future is uncertain enough to pay for insurance. Central banks are another layer. When sovereigns build reserves, they don't do it because they're excited about a daily candle. They do it because they're managing regime risk, currency risk, sanctions risk, geopolitical risk, and credibility risk. You don't need to romanticize this. You just need to recognize that a steady bid from institutions changes the character of pullbacks. It turns some dips into restocking events. But that's not the part that matters. Fourth proof point, physical behavior and retail symptom. In real-world markets like India, high prices can pressure jewelry demand while simultaneously lifting investment demand, bars, coins, and ETFs, because the motivation shifts from adornment to savings and protection. That rotation tells you something. Demand doesn't always disappear at high prices. It changes shape. When demand changes shape, the supply chain responds differently. Fabricators adjust, refiners adjust, dealers adjust, and that can feed back into spreads and premiums. Fifth proof point, silver's supply chain rigidity. Silver is not just poor man's gold. It's also an industrial input. An industrial procurement does not behave like a retail trade. If a manufacturer needs a material for production, They can't just say, we'll wait for the dip. They need continuity. Silver supply is also structurally constrained because a significant portion comes as a byproduct of other mining: lead, zinc, copper. That means silver supply doesn't ramp up just because silver price spikes. It ramps up when base metal production ramps up, and that's slower and messier. So when demand surprises to the upside, and when procurement gets nervous, the market can tighten in ways that charts warn to warn you about until it is already happening. And then you get the moments where silver moves like it has a switch. Because it kind of does. The next detail is what flips the whole setup. Now let ES add a sixth proof point that people either misunderstand or sensationalize: policy and trade flow risk. Anytime a major region changes export licensing, taxes, or controls around strategic materials, it doesn't just impact local supply, it changes the perception of reliability. Reliability is everything in a supply chain. If participants start to believe that future flows could be interrupted or delayed, they pull demand forward. They stockpile. They hedge. They pay up for the front end. That behavior shows up in spreads and physical premiums before it shows up in headlines. I'm not saying panic. I'm saying incentives. If there's a whiff of flow restriction risk, the rational response for certain buyers is to reduce dependence on just-in-time supply. That doesn't mean the world runs out of silver. It means the market reprices the risk of scarcity at the margin. And at the margin is where price is set. So if all these proof points exist, why does the market still whip you around like a rodeo? Because the paper market sets the day-to-day price, and the physical market sets the boundaries of reality over time. Think of it like a rubber band. Paper can stretch price away from physical equilibrium temporarily. But if physical tightness grows, if spreads stay stressed, if deliverable float gets tight, if procurement pulls forward, then paper can snap back violently. The snap is often triggered by something small: a data print, a risk event, a liquidity vacuum, a level breaking. That's why you're seeing this weird push-pull where the crowd gets convinced it SM over on every drop, and then price refuses to die. But that's not the part that matters. Let's translate all of this into what you should actually watch this week and next, because watching is the whole game. You're not trying to predict the future like a fortune teller. You're trying to map the conditions under which the next move is likely, and then manage risk around it. You might also see reduced gap risk and more orderly behavior, which tells you liquidity is returning. The risk in this scenario is impatience. People rage sell because it's not moving fast enough, and they get left behind when the base resolves upward. But that's not the part that matters. Scenario 2 is the continuation squeeze and gap risk scenario. In this scenario, the market doesn't give you the polite base. It rips again when liquidity is thin, often on something that feels like a non-event. The move is driven by mechanical buying, short covering, dealer hedging, and funds chasing as levels break. In this world, silver can behave like a switch. It jumps, pulls back shallowly, then jumps again. Gold can grind and then spike. Confirmation for scenario 2 looks like this: price reclaims. And holds above the recent bounce highs, the tape becomes one-directional and dips get bought immediately. Spreads stay tense. Volatility stays high, but it's up vol, not just panic selling. The risk here is obvious. If you chase late, you're the liquidity for someone else's exit. And because liquidity can vanish, you can get gaps against you. In this scenario, risk management is not optional. It's the whole game. Now, what would invalidate the bullish near-term setup? Not a red day, not a scary headline. Invalidation is structural. For gold, it would look like a clean break below the key zone that doesn't recover quickly, followed by failed rallies that get sold harder each time. It would look like stress signals easing, spreads relaxing. At the same time, price breaks down, suggesting the urgency premium is gone. For silver, invalidation would look like a decisive loss of the key zone with acceleration lower and no fast reclaim, combined with signs that physical and term structure tension is dissolving. That doesn't mean metals are dead forever. It means the next tradable phase is different, and you need to stop forcing the old narrative onto a new tape, because the market will punish you for loyalty. Now, let's talk about how you'll be emotionally manipulated in the next 1 to 2 weeks, because if you don't understand this, you will sabotage yourself even if your analysis is solid. The market's favorite trick is simple. It makes you feel late on the way up and stupid on the way down. On the way up, it shows you green candles and social proof, and it's going to the moon energy until you finally buy because you can stand being left out. Then it dumps violently right after you buy. And your brain tells you, you're an idiot, get out. You sell near the low. Then it rebounds, and your brain tells you, see, you should have held. Then you buy back higher, and the cycle repeats. That is not a lack of intelligence. That is human wiring colliding with a market designed to stress that wiring. So here's the shield. Stop treating every candle as a verdict on your worth. Decide what time horizon you're operating on. If you're a short-term trader, you must respect levels and stops and volatility. If you're a longer-term holder, you must accept that metals can swing hard and still be in a bull regime. Either way, you need if-then rules. If gold holds the key zone and reclaims recent highs, then the squeeze scenario is live and you manage exposure accordingly. If it loses the zone and fails to reclaim, then you reduce risk and wait for structure to improve. Same for silver, but more cautious, because silver is a knife when it wants to be. Your plan should not depend on your mood, because the market will change your mood on purpose, and that's where the real pressure starts. Let's do a quick reality check calculation to keep you grounded. If silver moves 5% in a day, and it can, someone on 5x leverage is effectively experiencing a 25% swing. Someone on 10x is staring at 50%. That means a move that looks normal to a metals veteran can be catastrophic to a leveraged newcomer. That's why you see these dramatic flushes. Leverage gets deleted. And once it's deleted, the market can move more cleanly because it's no longer dragging a chain of forced liquidations behind it. So when you see a scary drop, ask, did the structure break or did leverage get purged? If the structure holds, purges are often the setup for the next leg. If the structure breaks, purges can become trends. That distinction will save you more money than any hot take. Now, zoom out and connect this to the macro logic that makes metals relevant right now. Gold is not just an inflation trade. It's a credibility hedge. It's a hedge against policy uncertainty, currency debasement fears, geopolitical fragmentation, and the idea that the future will not be as stable as the models assume. Silver has that monetary shadow, but it also sits in the industrial bloodstream, electronics, energy systems, manufacturing chains. That dual identity is why silver can underperform for stretches and then explode when the conditions align. And when it explodes, the move is often faster than people expect because the market is smaller, positioning is more emotional, and supply is less responsive in the short term. That's why silver is so cruel to tourists, but it's also why it can become the headline when the setup is right. So what do you watch next specifically without drowning in information? Watch 3 baskets of signals. Basket 1 is structural. Key levels on spot, the behavior of rallies after dips, and whether the market is making higher lows or lower lows. Basket 2 is urgency. Front-end behavior, spread tension, and whether pay for now signals stay elevated even during pullbacks. Basket 3 is flow and stress, signs of forced selling, margin-driven liquidation, unusual volatility spikes, and whether those spikes are followed by quick stabilization or continued breakdown. Put those together and you have a map. Not a guarantee, a map. And now the quiet warning that separates people who survive from people who become a cautionary tale: volatility will be used against you. If you're right on the macro, the market can still make you wrong on timing. If you're right on the long term, the market can still force you out on the short-term path. The solution is not to become fearless. The solution is to become systematic. Reduce leverage, size positions so you can hold through noise, separate investment from trade, and never let a one-day candle rewrite your entire worldview, because that's exactly what the tape wants you to do. Now, let's bring it home with a clean, practical finish. 2 scenarios: what confirms, what breaks, and what you do with that information without turning it into a religion. Base case, controlled pullback and retest. Gold holds the key zone and begins to stabilize. Silver holds its key zone with chop, but without accelerating breakdown. Confirmations include quick reclaims after dips, improving structure, and urgency signals that don't fully relax. In this case, patience is the weapon. You don't need to chase. You need to avoid getting shaken out. Squeeze case, continuation move with gap risk. Gold pushes back through recent highs and holds. Silver reclaims strength and starts moving in steps. Up, shallow pullback, up again, because that's how squeezes breathe. Confirmations include one directional tape, dips bought instantly, and ongoing urgency signals at the front end. In this case, discipline is the weapon. You don't FOMO into the top of a green candle. You plan entries, you respect volatility, and you understand that gaps can happen when liquidity thins. Invalidation for both. Clean structural breaks that don't recover, combined with urgency relaxing and rallies failing. If you see that, the market is telling you to stop forcing the bull narrative onto a broken near-term tape. Step back. Let it rebuild. The market will always offer another trade. It will not always offer you your capital back if you refuse to listen. If you're still here, you're already in the minority. The group that doesn't just want a hot take, but wants mechanics, pressure points, and a framework that still works when the candle turns red. That it's the whole identity of this corner of the market. We don't worship headlines. We watch structure. We don't panic at noise. We look for confirmation. And we don't pretend risk doesn't exist. We manage it so we can stay in the game long enough for the thesis to pay. So this week, keep it simple and ruthless. Watch the key zones, watch the urgency signals, watch the calendar effects and thin liquidity, and watch how quickly the market recovers after stress, because recovery speed is information. If you want to stay plugged into the people who read the market this way, skeptical, evidence-driven, and allergic to hype, stick around because the next move won't be announced with a breaking news banner. It'll be broadcast through spreads, stress, and the moment the market finally admits the headline, price was never the full story.